I'm Pattu from FreeFinCal, and here are 18 mutual funds with better than index return and lower than index risk in the last 1, 2, 3, 4, and 5 years. So this is a new method of shortlisting mutual funds that I've worked on, and this is something that I've been wanting to do for a while, and I finally got to do it. So I want to share this method with you and also those 18 funds. We'll talk about how this method can be used and how does it compare with others. So what is this method about? So suppose you you draw a graph between risk in the horizontal axis versus return in the vertical axis. So risk is in the horizontal axis and return in the vertical axis. The risk is measured by the standard deviation, and the return is of course measured as the annualized return. And so now you can compartmentalize the graph into 4 sections. So you have in this region high risk and high return funds, which is okay. In the diagonally opposite region you have low risk and low return funds, and then you have high risk and low return funds which you do not want. You don't want to take on high risk and get low returns for it. And you have this section here which is the low risk and high return funds. So that is the desired place where a mutual fund should be. So in this map of risk and risk versus reward, that's where the mutual fund should be. So what we actually plot in the horizontal axis is we measure the fund risk and subtract it from the index risk, and in the vertical axis we plot the fund return and subtract it from the index return. So this means right at the center, right here, that position will be the position of the index, and anywhere else the fund will fall, and you know what kind of fund it is. If it falls right on the index, then you know it is not done better than the index. For an index fund, the index fund will fall right on the index naturally. So this map is inspired by the data that's available in Morningstar for a fund and a category. So this is HDFC top 100. If you go to the risk rating tab, you will get this. You can change it for 3 years, 5 years, and 10 years. And this is the risk return analysis that I'm talking about. I will show that in a zoomed up version here. So this is the standard deviation of the risk in the horizontal axis and the return in the vertical axis. So you can see that the fund falls. That's the index. The index falls right at the center, and the fund falls here. So which means that it has taken a risk which is higher than the index and given you a return which is higher than the index, which is okay. And the category, if you look at the category, that's bad, isn't it? The category has taken lesser risk than the index. So the index is here and the risk is, the category has taken higher risk, the category has taken higher risk but has given you a lower return. That's awful, isn't it? Higher risk than the index but lower returns than the index. But HDFC 100, I think this is over 3 years, has given you higher returns but has also taken higher risk than the index. So we're going to find out what my aim was to plot this for all the equity funds and find out how many funds were present in this place. So that is, you calculate the return. That's called the trailing return. So for example, today is March 5th. Suppose I do the calculation today. I calculate 1 year as March 4th, 2019 to March 4th, 2018. That's the last 1 year trailing period. Last 3 years means March 4th, 2019 to March 4th, 2016. So that's the last 3 year trailing period. So that trailing window will change day after day after day. So I calculate the return, the trailing return for 1, 2, 3, 4, 5 years. I calculate the standard deviation within that period. So between March 4th, 2019 to March 4th, 2018, there are 12 months, and I calculate the monthly returns of those 12 months, and I find out the average, and I find out how much each return, each individual return deviates from the average monthly return. That's called the standard deviation, and that gives you a measure of the volatility in the fund. So I calculate the standard deviation also for the trailing periods of 1, 2, 3, 4, 5 years. And once you do that, you measure, get all the data, and you make this kind of a graph. This graph is identical to what we saw in Morningstar, and we're going to find out all the funds that are present in this quadrant, that is the lower than index risk and higher than index return kind of funds. That's what we want. That's what we're paying the fund manager for. Of course, the fund can also be here. Higher risk and higher return is also okay. But personally, I prefer this, so I'm concentrating on this. You can shortlist funds like this. So from the next edition of the Free FinCal Equity Mutual Fund Screener, which is published every month, from the next edition, this kind of screening will be available. So this is the data for 3 years. So I have used 268 equity mutual funds, and that's the data for 3 years. So all three, out of the 268 funds, all the funds which were at least 3 years old will be found here. So that's like a, I don't know, 200, 225 funds or something like that. And that's the kind of funds that you want. These funds have got a risk which is lower than the index. The index is right at the center, right here, where I'm circling the mouse. So these funds have taken a risk which is lower than the index, but have delivered a return higher than the index. So that's what we want. And this is the final shortlist. I have taken the data, calculated used the Excel filter function, and found out all the funds over 1, 2, 3, 4, and 5 years with lower than index risk and higher than index return, and you can find out those are the 18 funds. There is only one ELSS fund, there's only one large and mid cap fund, there are 2 mid cap funds, 2 multi cap funds, 3 infrastructure funds, and 1, 2, 3, 4, 5, 6, 7, 8, 9. Half the list is full of small caps. Of course, why is half the list full of small caps? Because it is easy to manage a small cap mutual fund and make it less volatile than the small cap index. Because you just need to add a few mid caps, then the fund will become less volatile than the small cap index. And it is, of course, I'm not claiming it's easy to beat the small cap index in terms of returns, but at least in terms of risk, it is easy to have a fund which is lower than the small cap index risk. But of course, these funds are in of themselves good funds. I have reviewed Franklin India smaller companies. I think yes, if I remember right. DSP micro cap also. I have small cap also. I have reviewed from time to time. So that's the list. You can pause it and have a look, or you can click the link in the description box for a full post, and you can see the list in there. Now, every month I publish a screener in which I calculate the rolling returns, and I find out how consistently has the mutual fund bet the index over 1, 2, 3, 4, 5 years when you consider rolling returns, and also downside protection. That is, when the index monthly return was negative, how consistently was the fund return less negative than the index. So if you add those filters also to the filters I mentioned just now, then you get only these many funds. 1, 2, 3, 4, 5, 6, 7, 8 funds. Only 8. So it becomes less than half when you add in the rolling return consistency as well. That seems a little too strict to me in terms of shortlisting. You cannot make this kind of a too strict shortlist. But let's see. It's an evolving technique that I'm still learning how to do it. How to use this method? First of all, if you are following my channel for specific, mutual funds, I invest for me to say pick this fund or choose this method. This is not the right channel. I would like to learn different techniques and understand how to analyze data in newer and newer ways. And if you like this, then you can. You can be independent and analyze things yourself and be a pure, true DIY investor. That is what you should be looking for in my channel, not exact specific advice like if you want to go from point A to point B, take a right turn here, take a left turn there, and so on. I will say between point A to point B, there are 100 ways to go, and you just need to choose a suitable way. So that is my way of looking at things. And out of those 100 ways, this is yet another method to shortlist mutual funds. I am a little surprised that only 18 funds could fit this bill. It seems too harsh. Too narrow a shortlist, but I'm really surprised. But I'm also surprised that none of the large cap funds could fit the bill. That is bad, isn't it? That is, I'm demanding lower than index risk, higher than index return for 1 and 2 and 3 and 4 and 5 years. So that's an AND function. So if since it's so strict, it's surprising none of the large caps fit the bill, and there are only very few, only one large and mid cap, two mid caps, one ELSS fund. I'm very surprised that this seems this is the shortlisting is so narrow. It seems harsh, yes. There's no doubt about it. But why can't we judge funds so harshly? Well, if your shortlist is too narrow, then what happens is if your mutual fund moves out of the shortlist, then you'll feel, oh my God, have I made a mistake investing in this fund? That is a problem. So it's better to cast a wider net. This method is still evolving, but I think as of now, what you see here is perfectly usable, workable, and it will be available from the next edition of the FreeFin Cal Screener. But I'm also considering using rolling risk and rolling return instead of the trailing returns that I've used. So instead of one data points, that is, I've used one year data point, 1 2-year data point, 3-year data point, 4-year data point, and 5-year data points. Instead of that, I will use all available 1, 2, 3, 4, 5 return data points, periods, and calculate risk and return in them. That's called rolling return or rolling risk, and then redo this shortlisting and see how that works out. So please do explore this method. Please do explore the risk and return rating tab in Morningstar. Find out how you can understand about your fund's risk and return. This is in a way risk adjusted return. So I'm talking about funds that have bet the index in a risk adjusted manner. So you can explore the details on Morningstar, explore the post I've written, and if you have any questions about these methods or comments, please do leave them below in the comment section. And if you have any video ideas, go ahead and leave them. I'm looking for real problems that people are facing, real problems, money problems that you're facing. I would love to know what they are and work on them, because many people like you will also face the same problem. So I'll catch you in another video. Bye bye.